All right, all right. Good evening, traders. Happy Thursday. Let me see here. What is going on? December the 17th? No, December the 7th. 17 shopping days left until Christmas. Let me get my chat ready to go. Good morning, Sandy. Hello, Perry. Good to see everybody. There should be like 100% attendance here, and we're nowhere near that. I'm very disappointed. Some people told me they wouldn't be able to make it, but this is options December. That means something. So to those of you who are here, I salute you. Well done. Welcome to the Market Watch Group Options Foundations course, the inaugural round. Oh, I love this. I'm having fun with it. I had a lot of fun with the trading foundations. Really good. I'm going to now go back and on the second pass, I'm going to maybe add some pictures to my slides so they're not so boring, and clean the presentations up, find the things that didn't work or didn't make as much sense, get rid of them. Second round would be even better. I'm excited for that. Second iteration. Today, what are we talking about? Key concepts, terminology, basic options, strategies. We're going to just, for examples, and I was thinking about it, and I was like, oh, well, this is good because, or, not, it's good, but also at the same time skews a little because I have two stocks as case studies that we looked at the end of the foundations course. One bull, one bear. Well, they both worked. So, of course, when I show you calls and puts, you're going to see how they work. I didn't think in time, well, I should also show and this is what happens when it doesn't. But this will allow us to look at it, see what the option would have done so you can see that. Maybe we'll have time to open up and find a signal and build a potential trade tonight. I'm going to try to get through it. I want to make sure I leave you time for questions. Yeah. So hold on a second. My computer is frozen here. Something's going on. I'm going to pause the recording. And now I can advance. So today we're talking about key concepts, terminology, basic option strategies. We are going to be looking at buying a call, buying a put. I'm also going to show you think back. If you are not familiar with that and you use the Thinkorswim tool, it is a great way to go back and say, what would have happened if I did this? What? All right, let's get to it. My name is Scott. I'll be your host. Here are the disclaimers, as always, and they're in your email. Here is our agenda. First, foremost, option terminology. We're going to just pound it into your head. We have 3 different variations of intro to options. There's a lot of stuff there that you just kind of have to memorize and wrap your mind around. What's a call? What's a put? Who has rights? Who has obligations? What are those rights or those obligations? What is assignment? What is exercise? What is in the money, out the money, at the money, intrinsic, extrinsic, right? There's just a lot of these words that are Greeks, delta, theta, vega, rho, implied volatility. Yeah, I get it. I remember when I was studying for the Series 7, and it was like, ooh, it's overwhelming. By the way, a little known fact, Scott was the only one that year in the Salt Lake Fidelity office to score a 100% on the derivatives section of the Series 7. Whoop, whoop. I knew then options were my destiny. Okay. Oh, it's quiet out there. Give me a sign that we're all still here together. We're going to talk about key concepts. we are going to talk about the option Greeks. We're going to get little teasers in there. We've got a full session of the Greeks coming. Don't forget. And implied volatility, mesmerized. Sandra said. And I hope I mesmerized. That doesn't mean sleeping. Basic option strategies, buying calls, buying puts. Quick summary. We're gonna be in the model, right? We're gonna go in. We're gonna look at the think back, and then when we're done here, we're gonna go try to see if we can't find a call. We're not gonna look to buy puts. Why not? Because we're bullish. We are bullish. If we were to buy puts, if I were to buy puts, it's only going to come from one place. That would be a hedge. We're hedging. So that would be something that would be triggered by a very specific sequence of technical events. Typically, it's going to be something like a higher low or a break of a consolidation in the VIX. Might be a half a hedge, might be a full hedge. It's all very scripted. I don't need to analyze for that. That just sort of fires off if the script is satisfied. Here we're looking to analyze. So it's only considered a hedge when it's opposite of everything else you're doing. So right now, everything that we're doing or looking to do is bullish. Buying calls, buying stocks, covered calls, things that are bullish. Finding strong stocks in the strong market, then the hedge would be the puts to the other side. And if there were ever a time that you were bearish and you had shorts and bear calls and puts on, and then all of a sudden you're like, whoa, that looks like a sign of strength. What would we do? We'd buy a call, the other side. It's the other side. That's the insurance, if you will. Okay. Buying calls, buying puts, summary, then we'll do it. Let's get into it. And throw your questions as I go. Don't feel like you're going to interrupt me. I'm full ADD, which means I have a pretty good ability to just jump back right where I was, no problem. Options, terminology. This is another quick repeat. Let's just make sure. Call option. It gives the buyer the right, not the obligation, to buy an underlying asset. In our case, a stock at a specified price, the strike price, at or before expiration. However, we do not live as buyers. Sellers, maybe. As a seller, is there a chance I may let something go to expiration? Sure. But even then, if I can close a trade for 5%, 10%, let's say I took a credit of $2 and I can buy it back at 15 cents. That means I've made 90+% of the potential profit, especially if there's a couple of weeks left. I'm thinking, is it likely to just finish out of the money? Yes, but I'm tying up margin. I'm tying up capital for that last 5%. And imagine if that last week, that last couple of days, something crazy happened. This thing shot the other direction, and all of a sudden, you're like fighting for your life in the trade. And then you're like, man, I could have shut it down for 90%. What was I doing? You were picking up nickels in front of a steamroller. Seems good. Look at this, free money. What if that steamroller starts going? Then we might be in trouble. That's my thought process. Bob, no worries. Wrong link. Was it due to the fact that you didn't was that my fault? Did I not get the information out? Let me know if so. I just want to make sure that I do what I need to do to make sure the next time everybody has the right link. So let me know if there was something I could do better to get that out. Put option. Thank you. Sandy says she likes the analogy. Put option. The right to sell this time. Remember, a call option, we want the right to buy it because we think it's going up and we're locking in a lower price. With a put, we are looking to, whoops, let me see. I've got, I heard a message on, oh, hold on one second. I'm going to just quickly send a link. We might have a couple people join us. I think it might be on my end, Bob. I think it may be on my end. I'm going to ask a couple of people who are late. I got to make sure that I'm getting the information to everybody. I'm glad I saw that. Okay, let's keep going. We'll welcome the other people in here. Would I say options are more complicated than buying stock? Yes. They are more complicated, right? You buy a stock, when you're done, you sell it. There's no time value or expiration or implied volatility. It's not working on a separate market while following a different market. Yes, it's a bit more complex and sophisticated. But at the same time, it offers us, again, why? Why am I willing to accept that? What do I get for it? That's the sacrifice. That's the pawn. Why am I? They're asking me to sacrifice a pawn. Why? What do I get? I get a lot more tools that offer me flexibility for hedging or for trading more types of markets sideways, slightly up. I get better risk management, right? So yes, those are my advantages there. Okay. Though calls and puts. Calls, I'm bullish, locking in a right to buy. Puts, I'm bearish, I'm locking in a right to sell. So a call option is the option equivalent of buying stock. A put option is the equivalent of shorting stock. When you short a stock, you sell it at a certain price. With a put, you're locking in the right to sell it at a certain price. That should hopefully help you connect those dots between bullish and bearish. Remember that these are building blocks. We're building the blocks. And as building blocks, we always start with the perspective of a buyer. We buy options, buy calls, buy puts. I'm a buyer. Those are the basics. When we start thinking about selling, which is Tuesday, we're going to go fast. It's Tuesday. We're talking about selling options. So we've got to get through buying options tonight because that's what builds the blocks. We buy, we sell, we do both. Now we're spread trading. We buy one, we sell one. And you might think they cancel each other out. Yes, to some extent they do, but they leave something behind. They leave me slightly bullish with positive time decay and very limited impact by implied volatility. Great. That might be exactly what I was hoping for. That's the only way to build that is with that combination. All right. Michael, glad you could join us. If for some reason the link didn't get to you, I'm trying to make sure I get it out there various ways. I did forget to post it. I was actually meaning to post it in the group. I saw your guys' conversation, so I heard and slipped it in. Glad you could join us. Strike price. Remember that we're dealing with contracts. The strike price is the predetermined price of the contract. This contract doesn't exist. When you buy it, well, it might exist. It might exist. If you sell it, you're creating it. If you buy it, you're either buying it from an existing pool or you are essentially taking the market maker's place. So if you say, hey, I want to buy XYZ call at $50 and it's a $2 call, and you buy it, what happens? Well, someone has to sell it, which means it's usually going to be the market maker. So if that contract didn't exist, maybe he has it in his inventory and he's already looking for a seller, but most likely he's going to create that contract. Now, eventually he needs to find a seller to be on the other side of that contract. He's going to manipulate the price up and down to attract buyers and sellers based on what he has. If he owns a lot of contracts, he needs to find sellers. So what's he going to do? He's going to raise the price of the contracts until he can find a seller. And then he can sell his extra contracts at a higher price and he makes money. Yeah, it's good to be a market maker. Right? If he sells too many and he's negative, he needs buyers. Right? He needs to attract buyers. How's he going to do that? He's going to lower the price. As he lowers the price, people stop selling and start buying. And when they start buying, he's able to neutralize his position. So he wants to stay as balanced as possible, and he's going to do that by manipulating the prices to attract buyers and attract sellers. That's great information for us. We want to listen. right? If he's trying to attract buyers, we should be thinking, all right, he's not trying to trick us. Or she, they're not trying to trick us. If it's low, that just simply means that they're in too many shorts and they want to cover it. And they're going to cover it by trying to get somebody else to buy the contracts. And if they need to make it cheaper, they're going to. Because if they've already sold them at a higher price and now they lower it, guess what? They're making money still. And same thing from the other side. So if they're saying, hey, I need buyers, that means the options are cheap. If they're saying, hey, I need sellers, that means the options are expensive. We're going to talk more about that when we get to the concept of implied volatility, right? But just remember, strike price is the part of the contract that dictates at what price can we buy or sell the stock. Expiration date, that's how long we have. Remember, there's a little bit of subtlety and nuance to this. They stop trading Friday at 4 p.m. But they don't expire till Saturday at 12 p.m. So could someone theoretically be like, whoa, something crazy happened Friday night at midnight. I'm going to exercise my option. Yeah. So if you're a seller, you have to be ready to be on the hook. The only way to not be on the hook is to close the option before. And the same thing, the auto exercise only happens. So if you're a buyer of an option and you let it go all the way to expiration, and it's 1 penny in the money at expiration, your broker is going to automatically exercise the option, and you're going to buy the stock or sell the stock. And on Monday, you're going to be like, whoa, where'd all my money go? Well, I went to buy that stock. So one thing that I would say, we never just want to let options go to expiration without like a real strong understanding of what the risks are and what we should probably do about it. Expiration. At this point, mostly we'll trade weeklies. Remember that we have anywhere from 6 to 7 weeks of weeklies. And that typically will give us enough time. We may have to go to the next monthly beyond that, but for the most part, we're going to be trading short-term options with our swings. Whoops. Premium. When someone says the option premium, what does that mean? It's how much it costs if you're a buyer. It's how much you sell it for if you're a seller. It's going to be quoted on a per share basis. So when I said XYZ $50 call at $2, $2 was the premium. XYZ was the stock. $50 was the strike price. So $2 means what? It means that I'm paying $2 per share. How many shares does an option contract control? 100. So my price is not 2, it's 2 times 100. $200 per contract. Right? So that's, but when we set our orders, if I set a stop or a target, I set it as a per share. When we log our trades, we log it as a per share, and the spreadsheet will multiply it by 100. So get used to the premium being in that per share basis, and you've got to just tack on a couple of zeros so you understand what the true cost or true collection will be. All right, let's keep going. Terminology continued. Time decay. Theta. We lose money in time if we're buyers. We gain money in time if we're sellers. Implied volatility is the market's expectation of future volatility. Oh, I don't know what just happened to my slide there. I lost a piece. It's critical in option pricing, right? Implied volatility is the component that controls extrinsic or time value. That's the part that the market makers can manipulate to make them cheap or expensive. So if they have a bunch of options and they're like, man, we've had 1,000 people buy contracts, nobody sell them. What do they want? They're on the hook, right? Unless they can do what? Attract sellers. How are they going to attract sellers? Raise the price, right? They're going to raise the price. Open interest. Open interest represents the total number of outstanding option contracts in the market. We use that as a liquidity measure to understand how deep the market is, and therefore what type of market maker representation will that create? Not unsold, not unsold. So the way it works, the terminology, it's a great question, Sandy. The way it works is this: when I do an option trade, there's specific terminology. So as a buyer, I would be doing a buy to open, which means when I get out, it would be a sell to close. Now, if I did a covered call, Steven is not here tonight, but he does those. That means you own 100 shares at least of the stock, and you're going to sell somebody else the call, sell them the right to buy your stock. That is a sell to open, and then I would eventually buy to close. Well, think about the terminology: buy to open, sell to open. If I buy to open 5 contracts, that's going to add 5 to the open interest, and it's going to add 5 to the volume, which is the number that traded that day. The next day, volume starts over, but my open interest is still part of the open interest. And if somebody sold to open, they're a part of the open interest, right? And so if there's 20 contracts of open interest, that's not that many. That literally could be 2 or 3 people, one person. And how many market makers does it take to satisfy all those contracts? Only one. And if that guy's going to make any money, how's he going to do it? He's going to charge wide spreads. Bid of $1, ask $1.50. You pay the 50 cents, right? What if there's 2,000 contracts of open interest? Well, that means there's hundreds, dozens to hundreds of traders. How many market makers does it take? At least a few. So now what? Now they have to compete. And now we're going to see those spreads tighten up. That's why open interest is important. So open interest is liquidity. So any contract that is open, already open, whether it was buy to open or sell to open, and we don't know which, as you close it, you do a buy to close that will add to the volume and subtract from the open interest. So when we see a lot of open interest, we know that that means there's a fairly regular market in that option. What is an option chain? That's a listing of all the available options. When we go into the options, you'll see that's what we're looking at. Okay, let's keep going. Key concepts. Here's a few that we need you to be thinking about. In, at, out of the money. In the money. An option is in the money if it has intrinsic value. That means that the market price is above the strike price for a call. It's the opposite below that. So if I own a $50 call and the stock's at 55, theoretically I could exercise it, buy it for 50, and it's now worth 55. So I've made $5. Well, I don't know if I've made 5. What if I paid 8? If I paid 8, so intrinsic value does not, absolutely does not equate to profit. Because if you started with $10 of intrinsic and now you have 6, you still have intrinsic, but you're down 4, right? That's so in the money just simply is a representation of the current price of the stock relative to the strike price. Is there something there if you were to exercise? If not, it's out of the money, right? That means that the market price is below. So if the stock's at 55, I might have a 58. It's below it. It's all time value. At the money is when the market price is at or near the strike price. So in this case, if the stock was at 55, the 55 is the at. That's just the closest. In the money, it has intrinsic value. Out of the money, it's only time value. At the money, that's the closest strike. That's where we typically go to start looking at assessing the trade. And now time decay. Again, remember, this is theta as we talk about Greeks. And options lose value as they approach their expiration date, known as time decay. Remember that time decay, it works on an exponential basis. So it's slow at first, slow, and all of a sudden it starts speeding up, and then bam, the last little bit can fall off a cliff. That's around the money. If it's deep in or deep out of the money, time decay takes on less meaning because it just doesn't really impact it. But we're typically going to find ourselves trading around the money. Wait, what have I done? Did I go backwards there? No. And implied volatility. Implied volatility is the market's expectation of future volatility. Critical, and I think I had things on here twice. I sure did. That's my fault. I'll take care of that. Let's talk about the Greeks. Delta, gamma, vega. Oh, how did I miss theta? Option Greeks. Delta. How does an option behave as price moves? Gamma. How does delta behave as price moves? So delta is going to get bigger and smaller. Gamma tells us by how much. So it's kind of delta's delta. Vega. Vega, oh, theta was on the previous slide, wasn't it? Okay. I mixed my slides up, man. Vega measures the sensitivity to changes in implied volatility. If implied volatility goes up, options are inflating. If you're a buyer, that's good. If you're a seller, that's bad. If the options are already inflated and then implied volatility goes down, that means that they're losing value. If you're a seller, that's good. If you're a buyer, that's bad. And that is going to help dictate our strategies. That is Vega. Theta is how much do we lose per day in time. The core Greeks that we're really going to be paying attention to are Delta, Vega, Theta, representing price, time, and volatility. Okay, let's talk about basic option strategies so we can dive into the platform a little bit. Buying calls, we're bullish. We expect the asset to rise. We have the right to buy it at a predetermined price at or before expiration. If the stock goes up, we have the potential to make money to the upside while only potentially losing the amount that we paid on the downside. Those are our calls. Buying puts. Remember, bearish strategy. When we think that the stock is going to drop, we buy a put, giving us the right to sell it at a certain price at or before expiration. We profit from stocks falling or potentially insure against market downturns, and again, risk limited to the premium paid for the option. All right. How are we feeling? A lot of moving parts, a lot going on. Sandy said, geez, I love this. Me too. I'm with you. Can talk about options all damn day. All right, so let's get into it. Buying calls. What needs to be in place? Number one, bullish stock in a leading sector. We don't compromise that. That's the first premise. Well, what do we have on our watch list? Bullish stocks from leading sectors. That's meets our criteria. That's why we're so stringent with that criteria to put stocks onto our watch list in the first place. What else are we looking for? Plenty of open interest with tight spreads. Sandy had a question that said tight spreads, question mark. The spread between bid and ask. That's what the market maker's charging you. So if you see $3 by $3.50, that's 50 cents. That's $50 a contract that you're paying to the market maker. $50 a contract. If you look at the SPY, you might find 2-cent spreads. You're paying $2 a contract. My objective is somewhere between 2 and 10. No more than 10% the cost of the option. But I really feel like I should be able to keep it below 20 cents at all times. That's what we mean when we say tight spreads. That means it's liquid. That means there's multiple market makers competing. If market maker A won't do it for 20 cents, market maker B will, because they're thinking, I'm going to make up for it on volume. I can, if I'm only going to get 100 contracts, I need 40 to 50 cents a contract. But if I'm going to get 1,000 contracts, I can do it for 15 or 10, right? That's the thought process. So you're looking for efficient markets with competition. That's what open interest does for us. We need it to fit some system. These are the systems we trade. Could it meet others? Of course. We talk about bounces. It's bouncing off of support. We think about continuation. It's bounced off support. We missed the initial entry, but it's still good. Bob says, good volume. That's why I filter scans above 2 million. Ding, 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 ding. Winner, winner, chicken dinner, Bob. Is exactly right. People are like, oh, you need at least 500,000 shares. For what? Not for options, man. You're gonna find trash options, garbage options with garbage market makers. I don't do business with garbage market makers. To hell with that. Yeah, love it. Good conversation. What is it? Is it bouncing, continuing, or breaking out, or something else? What are we analyzing for as we decide which of those it is? We're looking for price, time, volatility. As far as price goes, you need a stop and a target. As far as time goes, you need to know how long will it take if you're right, typically maybe 7 to 10 days, versus how long you'll let it go if you're wrong, maybe half of that, 4 to 5 days. Volatility, is it high and you're going to be a seller, or is it low and you're going to be a buyer? Cheap or expensive? Based on all of that, we go to the pricing model and we plug our values in and we build the trade in order to determine the reward to risk ratio and position size. We're also determining, I could have put this into, we're actually going to be determining the strike price and the expiration, the reward to risk ratio and the position size. I blew it on a couple of these slides today, man. Oh, tell you what, we'll fix it. We'll take care of it. Buying puts. Look at my slides. What changes? Hardly anything. Oh, I didn't realize the size of the bull is changing. How about that? That's fun. Really, it's the front line. Now what? Bearish stock in a lagging sector or a leading down sector. Bob's asking if I'm hungover from my birthday. I didn't even drink, man. Hungover from the joy of life. That's it. Everything else is the same. I want to make sure that I'm finding an already bearish stock. So people are like, oh, that stock just went up so high. Are you buying puts? Hell no, it just went up so high. Listen to what you said. It's strong. I don't buy puts on strength. I buy puts in weakness. Stocks that are already a bearish play. Stocks in a sector that's leading down. Still want plenty of open interest. Still want tight spreads. Still looking for it to be a bounce, a continuation, or a breakout. Still looking to analyze for price, time, and volatility. Still looking to determine the strike price, the expiration date, the reward to risk, and the position size. Okay, let's pause. I'm gonna have to go fast. I'm only gonna do one of these. Let me show you this. That's not it. I went into the SPY. I went into the SPY. The SPY, this was a bullish case study from our trading foundations. Trade entry, the posture at the time was a 2.5, steady. So it was bullish, but it wasn't like strongly bullish yet. But it was a steady bullish, which means we definitely had the ability for anticipatory trades. So what was I looking at here? I went out to July's. And this was a trade. Let's just do 663. We're going to do 2 contracts. Those were a little expensive. Maybe we'll even go to 425s. Let's go to 425s. We'll do 3 contracts of 425s. 433 a contract. So what I've done is I've gone in my platform to think back. And I've set my profit and loss date to 525. You can see that down here. I set the trade date to 525. You can see that over here. I am back looking at July 23 options. These options have expired, but in the platform, we have the ability to go back and find out what was the price at that time, right, for this option. And then what? Then I can advance it. Now you can see this is 2 contracts. Or this is 3 contracts, and we're figuring, I'd say, maybe potential to lose $300, maybe 400, something like that. Okay, so what do? I advance this to the, nope, that's not it. I advance this to the 26th, and you can see it's making $243. Now, if we look at the position here, I want to get through this so we can actually look at a live one. Oh, no problem at all, Steven. So if you look, this was the 23rd, 25th, right here. Right there. You can see we had busted out of this, popped up, pulled back, higher high, right there. And it went up and it got to about, I'd say right in here, June 7th, I would take profit. June 7th, I would take at least one of the contracts off. So we'll make a note of that. And then the rest of it, you can see moved on up. And maybe we did the second one on the 14th, the last one on the 16th. So 7th, 14th, 16th. Okay, what would that look like? Let's go back. So we advance this and we keep going until we get to the 7th. Now, at the 7th, right there, our profit loss is about 1,600. Now, remember, the total cost is around 1,200, 1,300. The risk we're saying is around 400 or 500. At this point, profit loss open, 1,642. So that's about $550 for the first contract. So book a $550 gain on the first contract as we advance it. And this is trying to be as realistic as we can. We're saying, look, we would have taken profit at that first level with only one contract, though. Then I keep going and I get to the 14th. Well, now look. Now this is for all three contracts. Let's just go back. Now we would only have two contracts. The original contracts were $4.33, $433 a contract. Now the second contract, we've made $1,100 when we book a gain on that second contract, $1,100. And now we're down to only one contract. We go for 2 more days, 1, 2. That last trade, $1,500. 1,526. So the total there is about $3,100. That right there would be 3 contracts bought. These were out of the monies because the implied volatility was relatively low. Right? If we go back and we look at the implied volatility, you can see this is pretty low. It got lower still, but this was pretty low. Look where it was. And then it's over here, pretty low. That's what we can do with options. That wasn't a enormous move. It was a good move. It wasn't outrageous. You saw there was another one just like it right over here. We had another one like that back here and another one here. I mean, we see moves like that. So what can we do with that with options? If we do it right, we can really make some, huge amounts of, that was probably 250% of the original cost of the option on average, and that's even with scaling out, right? So why do I like buying cheap options? Imagine if we only made the 550. That's still 1,550 on a risk of what? $500-600, $400-500, something like that, like we said. That's what we're looking to do. Okay. Let me know if you have any questions. I'm going to take just a little bit extra time. Got a bill. Oh, Press. Thank you, man. Today is your oldest daughter's 20th birthday. Awesome, man. Happy birthday to her. Our kids are close. My son is 21. My daughter turns 19 in February. So I feel you, man. Have a great time. Sandy says many happy returns. There you go. Yeah, you got me a little bit. All right. Take care, man. We'll see you soon. Everybody else, let's build a trade. Let's hurry and do this. Let's find something. Adobe, good enough. No, shit. I don't have time. Tomorrow's Friday. We don't have time. I mean, you have a couple of days. You could try to play that. Let's keep looking. AIG, AMD. Come on now. AXP looks close. Look at that. Financials have pulled back and are looking to give us an opportunity again. Costco, CPRT, no. Fast enough. Oh, I know Perry caught Google. I was about to ask who caught this. I know Perry did. Very nice, very nice. IBM's gonna be tradable soon. Maybe ICE. Let's Intel. Oh, okay. Is it this one here? You can see we haven't exceeded the engulfing. It's still kind of a harami, but the let me zoom in on this a couple clicks. Boom, boom. I'm gonna put my stop just below this low. 41.10. No, let's give it we'll even give it a little more. How much do I have? 37 to, oh, this looks all right. I could even come down here, 40.80. Okay, so let's go to INTC. Barry said, yeah, buddy. Okay, what are we gonna do now? We're gonna first of all get out of ThinkPad. Let's go to add simulated trades. Let's go to Intel. Our thought process is 40.80 to the downside. To the upside, I'm looking for a higher high. I'm gonna say I mean, am I over ambitious at 49? Do you guys think? Bear with me. Let's draw some lines. One line there. Let's duplicate that. I mean, those are pretty close, those two. Am I right? Can we just ask for that again? I feel like we can. It's my party. Boom. Okay, not quite. I think we could say 48. I think I could go ahead and round it. Let me get out of my drawings. Let me make this. I'm gonna move it up just a little bit. Go there to 48. Okay, 48 it is. I can live with that. Okay, so what have I done? I've got price. I've got my target. I've got my stop. I've got my time frame. I need out to December 18th potentially. So what am I going to buy? I'm going to buy 10 to 14 days more than that. So probably if I need to the 18th, I'm probably going to buy the 29th or even maybe January 5th. Okay, so let's get back here. I'm gonna go 48 here. Let's take out 22 days or 29 days. We'll go 29 days. I'm gonna go. I mean, I could buy these at the monies right here. That's not terrible. Now, I don't love the open interest, 222. The spreads right now are about 23 cents, but I bet during the day it's a little tighter than that. I could always go out here. You know what? Let's just do it. There's no reason not to. We're just going to go out. We're going to look when I go to the standards. What I want you to notice is look at the open interest. 222, 213. When you get to the January, the standards, Why do you think the past will equal the future? I don't think it necessarily will, but that's what I have to go on now. When it moves, how does it tend to move? If you go back, you'll find that if you looked at this series of moves and then another series, very high correlation. So we're just basically establishing what is its pattern of behavior when it successfully makes a swing. Got to start with something, right? Could it get more? Yeah. If it does, would I get it? Probably not. I'd probably be taking my profit and moving on, because you'll see how much we get if we get just even that move alone. Okay, so let's go now. I'm going to go slightly out of the money to the 42.5s. You can see 29,000 contracts of open interest. Look at your spread, 9 cents. Perfect. Perfect. Now, I start off, and I've already established my slices. So now look over here. What do I have? PL open. I'm risking 600 to make 4,200. That's amazing, but that's false. Why am I saying it's false? Because that's as of yesterday. Here's my date down here. I need to advance this. I need to go to where would I be wrong? I would say for this trade, I'll know I'm wrong by the 15th. Let's just start with that. That's a week from Friday. So what am I doing? Well, if you notice here, I have theta. And in the middle, that's live. Now that's for 10 contracts. That's $25 a day I'm losing. So if I stay in it, I'm going to lose $250 over 10 days. I need to account for that. That's what the model is doing when I adjust this date. It's already accounted for in looking at this number, right? In fact, you can see I'm accounting for $211. I lose that if the stock doesn't move at all by the 15th. If it moves, goes to the 15th and then goes to 40.80, that means it's hitting my stop, but not all the way until the 15th. That's what I've defined as worst case scenario. If it gets to 42.80 sooner, I lose less by $25 a day. So if it gets there 4 days earlier, I lose $100 less. I want to know max loss, 800. That's max loss. What if I'm not willing to lose 800? I'm only willing to lose 300 or 400. Let's say 4. That's kind of what we looked at the other one. So instead of losing 800, I'm only going to lose 400. I'm going to dial back my contracts. And I'm going to buy 5 contracts because now my loss is $400. So you can see, what do I have here? I have my expiration, January 19th. I have my strike, 42.5, just slightly out of the money. I have my risk at 400. I have my gain at 2,000. That's a 5 to 1. 5 to 1. 5 to 1. Does anybody remember what the reward to risk ratio was? Because if you don't, it was 5 to 1. Oh, okay. Now what do I have? I've got a lot of work done here. I have my main target. I'll have to think of a second a primary target where I might take a little off. That's a different story. And how many? I have 5 contracts. I could take 1 or 2. That's 20 to 40%. Remember, I said right now I'm in that 20 to 33% range. So I might only do 1 contract, maybe 2, if I were to scale out. So I'm starting to think about that. We're still in stage 1 here. This is still stage 1, pre-trade. We're doing all our due diligence, but we're also starting to think about, if this trade makes sense, which it looks like it's going to, how am I going to manage it? So now at this point, now let me show you something. Let me show you something cool. Okay. Here's my chart of Intel. Okay. Let me give this. If you don't know how to do this, if you come in here and you go to time axis and you go to expansion area and you say 20, it's going to give us a little extra space over here. Okay. I'm going to go back to analyze. I've got my slices. Now look at my slices. The middle one is unlocked. That's live. I want that to move up and down as the stock moves up and down. These 2 are locked at my stop and my target. I come here to this little tool and I say slices to charts. Bing. And now what? Look at my lines. That's where we are right now. There's my stop hovering below that candle, like we said. You might look at that and say, you know what? I want a little more space, or I'm too loose. I could go a little tighter. I like it where it is. I think that looks great. I'm giving it some room underneath there. I have my target up here. My target should be reasonable. Does that look reasonable? Yeah, it's not that much higher than the last one. It fits in this, right? I actually, no, that doesn't look like it's got my target, does it? Something looks off. Hold on. 48. It misdrew it. It should be at 48. Come on. This is at 46. Yeah, I don't know what happened to that one. Oh, no, it is there. It is there. It's up there at 48. Sorry, what's this line? Did I draw that previously? I don't know. Anyways, it's there. It's all there. And now I can visually see my trade. And as it moves, these lines stay there for me. That is buying call options. Very cool. We're going to look at this tomorrow. We're going to look at this to see if we have confirmation of this trade. Let's do a quick recap. I'm eating into your time, I know. What do you guys think about this methodology that I went through? It should help you really have a strong sense of your risk levels and things like that. Brad says I couldn't leave. I'm sorry, man. I know how daughters can be. Recap of session 1, key concepts. Hopefully you have a good sense now. Contracts to buy, contracts to sell. You've got strikes, you've got expirations, etc., etc. Buying calls, great. We have a sense of that. Buying puts, we may not be bearish for a while, other than like hedges, but okay, we at least have an ability to play around with it a little bit. Transition to session 2. Next session, we will explore the complementary strategy of selling options, diving into the dynamics of generating income, managing risk through the process of writing both call and put options. Awesome, Bob. That's the right attitude. He said it was a little too fast, but he can rewatch it. Go back, watch us build that trade. Maybe we'll have time to do one tomorrow in our closing bell session. But yeah, that's it. Thanks, everybody. I think that we're going to end up going long on option days. I don't see any way I can possibly do this in 45 minutes. That's just madness. I'm not a superhero. I'm just a trader. Oh, okay. I'm just kidding. All right, you guys. Thanks. Thanks for coming out. I'm having a blast. I'm having so much fun with options with you guys. I'm so excited for 6 more of these. And I'm excited to be talking about what we're doing here in our trading session. So join me tomorrow, usual time, last 45. Thanks, everybody. Have a wonderful night. Happy birthday to Press's daughter from all of us from around the country. Bidding her a happy birthday, and for everybody. And as always, happy trading.